you just don't know what's going to be the next big company. So all of the founders are really tough, smart. They want to do things quickly. They're very demanding and they're poor. And that's the kind of client that I decided to focus on, believe it or not. My first advice to most founders is keep it simple. Keep it simple. What about the shareholders agreement? Look, if you can't trust your co-founder for 6 months, because that's when the next agreement's going to come in, maybe you shouldn't even get started, right?
Hello and welcome to Brazil is Not for Beginners. Today, I'm excited to be here with Eduardo Zilberberg, the Z in BZCP. Eduardo is the co-head of the venture practice at BZCP, and we're going to talk a little bit about the venture life cycle here in Brazil. Eduardo, thanks so much for joining me.
Thank you. Thank you for inviting me. I'm an admirer of your podcast and excited to be here and share some thoughts on the Brazil venture ecosystem.
Awesome. Like I said, Eduardo, you are a lawyer here at BZCP. Too many names that are too hard for me to pronounce. You can do it correctly later, although I think you've pretty much adopted the BZCP moniker. And like I said, you are the Z in that. But before we get into the venture ecosystem, to just hear a little bit about your background.
Sure. So I was born in Rio. I'm a Carioca, though I'm a fake Carioca because I've lived in Sao Paulo for so long that I've already lost most of my Carioca accent, which is one of the first things you notice about a Carioca is how heavy the accent is.
My wife is a Carioca, and I find that it comes out strongly when she's with other Cariocas. So I don't know if that happens with you, where it comes back, or you've been in Sao Paulo long enough that it's all gone at this point.
It's almost gone, but definitely if I spend a lot of time in Rio, it creeps out again. One thing that's different when you compare like US to Brazil is that you kind of have to decide when you're like 17 or 18 what you're going to, in theory, do for the rest of your life because there's no college, right? You go from high school to law school or med school. It's really, trying your best to figure out where you might end up. And I used to write well, and I was pretty good at getting out of trouble, finding convincing arguments not to be punished. So that's how
you would get into trouble, but then get out of it. Excellent.
And so naturally, I went to law school. I like traveling. I like languages. And so I always wanted to do something international. And I started being interested in business. And I decided I wanted to do cross-border deals. So that meant I had to study and work abroad at some point so that I would understand how business is done offshore. And so I was admitted at Stanford. I spent 1 year in California studying there. It was great. At that point, I had no clue I was going to end up with venture capital. And there I was in Silicon Valley. But then I went to work in New York for a big firm, started working with cross-border M&A, and actually had a tough time finding a job because I graduated right about in the middle of one of the worst financial crises in this history of the US, which was around January of 2009 was my job fair right after Lehman Brothers had gone bankrupt. So there's some fun stories about getting that job. But then I was working with cross-border M&A, and there I was thinking, I made it in New York, so now I can make it anywhere. But, I started feeling like I was missing a sense of purpose and fun in what I was doing. And I think that's how I ended up working with venture capital, still as a lawyer, right? But I started seeing more purpose in helping entrepreneurs really through all the challenges that you have to face to fundraise in Brazil and build a successful business, right? So that's where I really started getting excited and feeling like I was adding a lot of value to, founders. And just to finish the story, I went back to Brazil and I started my own venture practice. But then I think it was 2018, activities started really to pick up and I wasn't finding people, other lawyers that knew venture capital. So it was very hard to hire and grow. And so I looked across the table and saw 3 partners from different firms that were trying to do what I was trying to do at the same time. And we were actually being nice to each other across the table, which is not always the case with legal teams. And so we decided we had to do something together. And so I invited them to join my firm. They invited me, and we didn't want to go to another firm similar to where we were working. And so we said we have to create something completely new. And at that time, there wasn't really a firm that was focused in tech transactions in Brazil like you had Cooley, Fenwick, and other very known firms that focus in venture capital worldwide. So we said, okay, we have to do this in Brazil because that's where the secret is when you find something that is missing and is going to add a lot of value to founders. So yeah, that's how we started BZCP. BZCP, with the four of us getting together and joining, our teams. And then we created a brand and we were able to hire even more people after that. So that's how it started.
Excellent. It sounds like also good lessons for founders in that you guys created a new entity and went through the founding practice there.
Yeah, that actually helped me a lot to understand what founders go through, because we actually had to start from scratch and we left our revenue at our respective firms. And so we started literally paying for out of pocket the other lawyers. And so that paying with your own money to start your business is one of the pains and challenges of a founder. And it was funny because we had to open a bank account and we had started the firm. And I'm mentioning this because it ties to your whole topic here, but like we had to start immediately our firm. So we had my partner's wife set up the entity under her name so that once we announced, we could immediately start invoicing in this entity. And we changed the name of the entity to BZCP, or the long version, right? But then we couldn't change the bank account's name to the new firm's name. So for about a month, clients were trying to pay and they would see the last name of my partner's wife and they were like, okay, am I paying to the right bank account? And sometimes they would hold the payment. Like, okay, I'm actually dealing with the bureaucracy of not being able to change the name in my bank account.
Yeah, very Brazilian.
Exactly what my clients go through. So,
You lived it a little bit. Excellent. So now at BZCP, so you started in corporate law, looked for meaning. Did you start doing venture in the US or only when you came back to Brazil?
No, I started doing venture in the US, and that was actually very important so that I could, bring to Brazil all of the good practices or what the funds wanted to see in terms of governance and structures, right? So
Okay, cool. So you came back, you're doing your own thing, started BZCP. Can you talk a little bit about your specific focus? So you co-lead the venture practice. There's more things that BZCP does, but can you talk a little bit about where you focus in terms of supporting startups and the areas you focus on?
yeah, so I should mention our firm is really full service for tech, but my specific focus is on the fundraising journey. And that involves helping founders understand what's the ideal structure for fundraising, whether it's in Brazil or offshore. What's the ideal structure for the actual investment, or whether it's going to be a safe, a convertible loan, or priced equity round. Like, what's the ideal moment and check size for each? Talking about founders and co-founders and how much equity should I give to my co-founder, or how much equity should I give to the new CDO? How much equity should I give to, an advisor? Or I'm not getting along with my co-founder. What should I do in the middle of the fundraising journey? They're running out of money and they can't fundraise. They can't raise the other round. So when should I decide to shut down the company versus how long can I continue before I can't pay the shutdown costs anymore? And the fact is, I've helped founders that are raising $100,000 up to $100 million before they get to like a full exit. And so the range is huge. And the fact is that you just don't know what's going to be the next big company. So all of the founders are really tough, smart. They want to do things quickly. They're very demanding and they're poor.
Yes.
And that's the kind of client that I decided to focus on, believe it or not. You just don't know what company is going to do well. So you kind of have to bet that all of them are going to do well and just treat every founder as if, they're going to be the next unicorn. And so I think that's what really founders appreciate, someone that gets it and understand the real challenge that they have before them and the need for speed. So
Yeah, it sounds almost like a venture capital portfolio as well, right? Where you kind of place a bunch of bets, hoping that a couple of them pay off in the end.
I think the difference is that I don't have the equity upside. On the other hand, I don't have to wait that long to be able to capture value, after they receive their first proceeds of a relatively small round, we can already charge. So we don't have the super upside of someone that's going to wait 10 to 15 years to see that upside. But yeah, in a way, statistically, most of these companies are not going to go anywhere. So you're really working against the odds.
Very cool. And so you mentioned a lot of things there that I want to dive into in terms of founder dynamics. And I mean, it sounds like you're more of an advisor than anything else, right? So there's obviously like the legal processes and understanding the requirements, but there's also just a lot of lived experience that you probably share with these founders. And I would love to walk through that venture lifecycle with you. But maybe before we do that, can we take a step back and just talk a little bit about the dynamics of the Brazilian venture ecosystem today? So what are you seeing? What are some of the factors that make Brazil an attractive place for investors and for startup founders, and also kind of some of the challenges that you see?
I think Brazil is, as people say, the land of opportunities, right? So that's what's most attractive about Brazil is that you can really build a huge business that hasn't been thought before and add a lot of value. And it's a huge consumer market, right? So there are not that many consumer markets of that size and that actually culturally enjoy similar things as, say people who are in the US market. So there's a lot of opportunity there. It can also be a pitfall because in the beginning, people will be like, okay, I have this successful business in the US. I'm just going to bring it here, translate it to Portuguese, and then we're going to make millions. And I think a lot of companies learn the hard way that's not the case. It's very different in terms of timing and the cultural and local adaptations that you have to do to the business. And sometimes you have to adapt it to a point where it's not even close to what it was, for example, in the US. The ecosystem here grew a lot in the last 10 years or so. 10 years ago or 15 years ago, it was really very few deals, almost no local funds. And we have a very robust ecosystem now. And it started, I think, around 2017 with SoftBank promising to invest $5 billion in the region. And then all the other funds were like, okay, we can't stay out of this, or we need to be competitive, and started also pouring cash into companies. And then you started seeing early stage funds, seed, very early stage funds starting to put money in PowerPoints, which is something that you hadn't seen before. And so all of that contributed to a very healthy ecosystem until we got to a point where, in 2021, we were doing like one deal every couple of days, and it was crazy. And of course, in the end, it was kind of a bubble with the inflated valuations and people having all sorts of crazy ideas trying to get funded. And then, in 2022, we had a big correction, right? People went kind of back to reality and very careful about what they were going to fundraise next. It was quite a roller coaster, but I think where we are now is that there's a lot of healthy investing. Investors are really making sure that the company has healthy numbers and has a business model that makes sense in the long term, and taking their time to really decide if the investment makes sense, which poses challenges because then you have a kind of a liquidity crisis and you have like a natural selection where some companies are being funding healthy valuations, others aren't able to fund, and you have the same thing with the funds themselves. Some funds are not being able to fundraise and others are. And this is where we're at now, kind of a natural selection, but at the same time, a more healthy pace of investing and giving it a lot of thought. No more wiring the money before the agreements are signed.
Yeah, which was happening in 2021. How much of the bubble and the correction, for lack of better terms, is the relative youth of the ecosystem? Kind of where do you see the maturity of the ecosystem and how is that factoring into some of these things? So as an outsider, and I don't deal with this on a day-to-day, I see more angels. I see more early stage funds. Still maybe not so many kind of Series B, Series C local funds, but more relationships with the bigger funds overseas. So how do you see the dynamics changing in Brazil as it becomes maybe a more mature market, or is it not becoming a more mature market?
Yeah, I think first you have to put things in perspective because as mature as we've become, if you think about 2021, the peak of investment in venture capital in Brazil, we received, I think, about $8 billion in investment. At the same time in the US, I think it was 350 billion. So you have to put things in perspective. But yeah, when you instead of comparing like with the US or with China, if you just stick to Brazil and you see what happened in the last 5 to 10 years, it grew a lot. So yeah, there was no angel investing before. It was mostly friends and family. We do see quite a bit of angel investors now. It's not even close to what you see in the US, but you do see more of that and angel investors trying to get organized in a vehicle and invest at least $10 million. And what you see more that wasn't there before was CVCs and private equity shops and family offices, all of these trying to invest directly. Now, obviously, most of that started in 2021 when nobody wanted to miss the party. And so a part part of that went away when they realized that, I don't want to say the party was over. It just was harder than you would expect to see, exits and all this talk about let's do a business and IPO in a couple of years became clear that, it was going to take longer. So we definitely see a more diverse ecosystem with all kinds of companies investing in venture and the quality of founders as they become second time, third time founders.
Or just a PM at a company, right?
Yeah. So that really improved the quality of entrepreneurs in Brazil who had learned many lessons up to this point.
Awesome. I would love to spend a little bit of time walking through the venture life cycle and kind of the advice you provide at different points. So obviously you meet different people at different stages of their journey, but let's pretend that you're going to do the full life cycle with somebody and we can just walk through that venture life cycle. So I don't know, we're at some accelerator event and we meet and Eduardo, I have this cool idea. How do you start talking to me as a founder? And what is the advice you start to give me? And maybe we can start with those initial stages of kind of company creation, structure. One of the things you and I were talking about beforehand, the complication of founders agreements. So let's start with that, and then we can move through as somebody, raises a pre-seed, raises a seed. I'd love to just see how your role as a lawyer and advisor changes, and what are the considerations that startups need along that. I know this is a long, complicated question, so we'll have some back and forth and discuss.
Keep in mind that my job is to answer complicated questions every single day. So it's totally fine. And founders come to me really early on when they're thinking about raising their first check, right? Sometimes if they're working just on an idea or a business model, usually it's a little too early. But as soon as they decide, okay, now I want to go fundraise. And yeah, sometimes when founders come to me, they've already raised, I don't know, $100,000 or so with friends and family. But now I think, everybody is really closer, globalization and all, but even more so after the pandemic. It's very quick for a founder to be talking to another founder about their challenges. And then that founder says, hey, do you know Eduardo? Like he helped me with my startup. So that used to happen, 10 years ago, used to happen like after a Series A or at the time of a Series A. Now it happens much earlier. People are really sharing insights and recommendations much earlier.
And there's more ecosystem events, I think, as well, right? So I did Latitude and we met through our friend Paul, and you see these events and there's more, something I want to talk about more later, but community, especially in different cities, right? And so you tap into that.
Yeah, more events, more podcasts, everything. And so founders come to me and they're still thinking about equity split and their first shareholders agreement or, how they're going to fundraise. And sometimes it's challenging. Sometimes they'll get an investor who wants to invest R$1,000,000, which is less than $200,000, and wants full shareholders agreement with a board of directors and vetoes and whatnot. And sometimes you have to kind of debunk that and you'd be like, no, this does not make sense for $200,000 to spend, I don't know, at least a quarter or half of that money with the structure. Like it doesn't make sense. So my first advice to most founders is keep it simple. Keep it simple. What about the shareholders agreement? Look, if you can't trust your co-founder for 6 months, because that's when the next agreement's going to come in, maybe you shouldn't even get started, right? So, you might think that I'm going to say, no, the first thing you need is a shareholders agreement. No, you have to keep it simple in the beginning. It's good to have somebody who controls the company. Sometimes you have some, when you do like the 50-50 split, you have some challenges there when it doesn't work out. But yeah, you should try to keep it simple in the beginning and then adapting the corporate structure of the company and the fundraising method, whether it be a safe round or a convertible loan, to the check size and the investor. I think that's kind of the challenge. Sometimes for the founder, it's like similar, right? Whether it's a safe or a convertible loan. And then I have to explain, no, look, with a convertible note, interest rate that you're going to pay and get further diluted with this interest, whereas the safe doesn't have that. So very basic things that you have to explain and make sure the founder gets like the different implications, right? So that's kind of where it all starts. And I try to be very business minded. So I focus more on like what kind of valuation you're getting. Sometimes founders get offers for like $200,000 for 50% of the company. And they come to me, what are your thoughts on this agreement? My thought is do not sign it. Sometimes that's the trouble with the legal profession. Sometimes you're very focused on the legal advice. And I think founders, especially in the beginning, do need someone who is really business minded. And let's talk about whether it makes sense for you to fundraise at all in these conditions, right? Not just like what's the appropriate legal term. term here. So a lot of that in the beginning, a lot of the discussion is around like, what's the ideal partner for me? Equity distribution, valuation benchmarks, how to simplify the structure. And sometimes the founder needs an advice, needs someone to tell him, look, you can actually do this later. You don't have to do it now. He's like relieved. Oh, you're the lawyer saying I can do the shareholders agreement a bit later.
I like that idea of keeping it simple. And for those who haven't heard of some of the terms, so SAFE is a simple agreement for future equity, right? So it's kind of postponing the actual agreement and you're getting, really it's a convertible without interest payment is basically what it is. That's relatively new to Brazil, right? So how do you think as well about things like creating the company in Brazil versus creating international structure, which I think some of the rules on that have also changed around taxes. And then I guess related to that, how often do you get people that are coming to you and they've created a company here in Brazil to test their demo or they're already with clients versus somebody coming to you before they've quite launched? Maybe they're testing, they have a website and they're doing some collection, but they haven't actually started the technical or the official company. And kind of how does that factor in?
So most clients already have a legal entity when they come to me, I will say. And the founders that come to me before that are the second time founders or the founders that already built the business with me as an advisor and say, okay, now there's going to be a next venture, go ahead, get started. Let's set up the entity, but they already know what they want. Whereas first time founders are very like, let's test the waters. Let's set up this entity. Sometimes it's an entity that addresses their home address, right? What I say is like, look, until you start getting bigger checks from institutional investors, you should just keep it simple. Like do a convertible loan agreement in Brazil, as simple as it can be, and that's it, right? But at the end of the day, you have to have a structure and governance that invites investors in, and they want to see things that they're used to seeing. So a lot of people talk about the merits of establishing an offshore structure versus a structure in Brazil, like the pros and cons. Is it worth it? Why am I going to set up an offshore structure if I'm going to sell the Brazilian entity in the end? And the fact is that for investors to put, a $10 million check or more, they're going to need that structure. That's what they're used to. That's what they want to see. It's very hard for a foreign investor to understand the implications of sitting on a board in Brazil and having lawyers tell them that they can be held liable for labor debts of the company. I'm sure you've heard that in your podcast before, but it is really strange and unfamiliar. And so part of my job here is really helping the founder set up a structure that the investor is going to be really comfortable in. Because the decision to invest in Brazil in a venture that statistically is not going to work is already a tough one. If you're going to add more complexity and have the founder and have the investor, now you have to enroll with the Brazilian central bank so that you can make a transfer to a Brazilian account. And sometimes the investors can be like, you know what, I have these other investment opportunities here. I think I'm going to focus on that, especially if you're talking to accelerators like Y Combinator and others. Like they're not going to adapt their structure to invest in Brazil. They do so many investments that if it's not standardized, the time spent and the cost adapting wouldn't make sense. So when Y Combinator says, hey, you Brazilian founder, you want to get on board, you have to have this Cayman, Delaware structure. Oh, but so expensive for such a small check. Yeah, but it is what it is. That's the structure that we're used to, and we can't really adapt. So founders early on start getting that feedback. And sometimes they get that feedback even from family offices that are Brazilians, but they want to have an offshore structure so that they're kind of more shielded from liabilities here. So we often have this strange scenario where we have Brazilians investing in Brazilians, but using the offshore structure. So as far as life cycle, you asked about that. And so in the beginning, it's really keeping it simple, raising a pre-seed round. And in certain terms of offshore structure, it really depends on who your lead investor is. If it's a foreign investor, you might need to have an offshore structure right from the start.
Are there any other things that come up when you're in the pre-seed seed stage that is different when you're dealing with international investors versus local investors that you see? Or is it really just kind of that decision around an offshore structure and whether these foreigners or the locals frankly want to deal with the Brazilian bureaucracy?
There are many differences when you're using a local structure versus an offshore structure. You have to make two distinctions here. One is the differences when you're using a local vehicle to fundraise versus an offshore vehicle. And the other difference is the type of investor, right? So a lot of early stage, we see, for example, companies, big companies wanting to like seed a startup. And then of course, what they want in terms of governance is very different from what a VC fund expects. So in the beginning, it's really all kinds of terms that you see. Like one time I was trying to have a local investor use a SAFE, which is the simple agreement for future equity. And then he says, that's fine, but I want to add like a maturity date. I want to add a valuation that can vary from 20 to 80 million,
And you're
depending.
like, wait a second, it's a simple agreement.
I actually coined the term CAFE, which is complicated agreement for future equity. It's like, oh, I didn't say you wanted a CAFE. Let's see if we can do that. But you have to have a bigger check so that we can have a budget to work with. It is very different depending on the type of investor. And also when you invest in Brazil, there's some things like, for example, you have to offer everyone pro rata or like the opportunity to invest in future rounds proportionally. Whereas with the offshore structure, you can cut that and say, offer that only to a couple of investors so that you have an easier time figuring out your next round. And so there are many differences there. I can go on and on about it.
Are there any other differences that you see in terms of kind of the early stage diligence process from the later stage diligence processes in how investors, whether they be local or foreigners, think about those diligence processes and kind of what they're looking for in an early stage, as well as what the founders themselves are perceiving and reacting and dealing with them? And I say this because, as I've discussed before with other people, and you know better than anybody in doing this all the time, right? An early stage business is, I believe, in Eduardo, he's going to figure it out, whether it's this idea or something else. Maybe he's going to pivot. There's less proof in the pudding. Whereas later stage, you're investing in a Series B, it's an established business that has real numbers. I'm looking at path to profitability. I'm looking at very different things. So as we're still on this early stage before we get to Series A, what are the different dynamics that are there when you're dealing with local and foreign investors?
Yeah, so I think there are similarities and differences. The similarities are that both local and foreign investors are going to look for two things mainly. One is, who is this founder? Can he get there, right? Does he have the tools? Does he have the vision that is necessary to build a great business, right? Can I trust him ultimately, right? And the second is the business model. Does it make sense in general? And then secondly, because you can have a great business, but it's not going to bring the kinds of returns that I need compared to the risks that I'm taking. So these are very important questions that I think both VC investors are going to look for in general, whether they're local or foreign. Now, one thing that is different between foreign investors and local investors is that local investors are more used to the sort of things that you see, whether it be bureaucracy or liabilities that you see in an early stage companies. So, for example, hiring employees as contractors, which is a very typical thing that is done, and you kind of need to do it. Otherwise, the cost of hiring everyone as formal employees becomes higher, and then you don't have the runway to get where you need to get. So, Brazilian local investors are very used to that, and they've already devised a way to being able to invest and not worry about that, which is a convertible loan so investing, but not becoming a shareholder, right? Whereas foreign investors are mostly trying to rely on local investors. So it's very rare to see foreign investors investing huge checks in a completely unproven business. If it's a very small check, then, I guess they're just going to think, whatever, if it doesn't work out. And they're going to do a lot of benchmark, other foreign investors already invested in these conditions. But a lot of times they will want a local partner, a local VC to invest together with them, precisely because they're used to these particularities and challenges, and they're comfortable investing, and they can tell the difference, what's something that is going to be overcome soon enough, and what's a challenge or a liability or a red flag that is a real no-no, right? What they're looking for is similar, but yeah, they have different degrees of comfort. Local investors are more comfortable if they are VC minded. Now, if you have local investors that are not VCs, and they can be large corporations, family offices, and private equity shops, they're going to have a different look altogether. But all in all, it's good to have different kind of actors in this space, because especially in 2022, a lot of the VCs back. So, my job is kind of making sure everyone gets comfortable, like finding a structure that everyone is comfortable, because what's more important is having more investors willing to invest in these ventures, right?
Right. Like you said, making it more attractive. And I guess related to it, what are the conversations you have at the early stage with these companies that you're advising in terms of who they're talking to, the types of checks they take? Everybody wants an A16Z or a Kleiner Perkins on their cap table, but there's trade-offs, right? Then you're just one more firm in their portfolio versus somebody that you've never heard of, the local investor. One of the things you were talking about before, time of the fund, right? So how much of this are founders aware of, and how much do you have to talk to them about this?
This is a good point because there's a lot of the brand name when it comes to choosing your investor is still very important. But I try to talk to founders and say, look, who in that firm is talking to you? Is it an associate? Are the partners interested? Like, have you talked to founders that received investment from that firm? And sometimes they haven't. They'll say, no, why? I mean, it's super established firm. And I'm like, look, you have to do your own diligence, right? But of course, I'm also mindful that that comes more into play when they have a few offers, or at least more than one. If they only have one offer, then yeah, maybe you have to be practical and just look at the terms themselves. But before looking at the terms, to the extent possible, understanding how the partners in that investment firm think and what they want to get out of this investment, and hearing things that you don't want to hear, I think is even more important than hearing things that you want to hear. So that's pretty important. And then, of course, you look at the terms, and I've seen multiple cycles. And so it's easy to see when you have something that's really off market, doesn't make any sense. And sometimes I tell founders, look, you better not start at all if it's going to start like this. So
Yeah, I think one of the points, which is being able to think about the right fund company fit, right? And so sometimes you go for a brand name because you think that that'll be good, but they might not be the right fit for you versus somebody that is a better fit for you because the investor is better connected locally. It can open doors or has experience with this or is going to be more dedicated to you, provide more practical advice. And so there's always this trade-off. And I think it's come up in a few other conversations I've had about understanding the interests and the dynamics of the funds because they're not charities. They're looking for big returns and they want them on certain cycles. And it's important to understand the dynamics of the market that you're in and who's investing in you and why. I think you touched on that. And let's assume now that we've created a company. Eduardo's got his business running. He's got some clients doing well, captured his first round, probably on safes, and now coming to a late seed or a Series A. How do the dynamics and the advice you're giving to that person change? And what are the different things that that person needs to keep in mind as he's doing that next round?
up until that point, they've only agreed in theory on how much equity that investor is going to have in the future. But in terms of governance, it's pretty much whatever the founder wants to do. There are exceptions. I've seen, especially after the crisis or correction in the tech market, we've seen a lot of side letters where some investors try to pre-agree on what the rules of the game are going to be after the next round. But as a general rule, still the founder controls the company, the founder makes the decisions, and the investor's protected by the fact that he has to get his investment back, which is the liquidation preference, right? He gets his investment back before the founder gets anything. So that's pretty much the only protection that the investor has, alongside with vesting, which is also an important protection, which means that if the founder leaves the company, he has to give his shares away. So the investor has these two protections, but as far as governance, is pretty much whatever the founder wants to do. And when the founder then gets to his first price round, and we've seen, there are different amounts, but most of the time, if we're talking about more than $5 million investment, then you're talking about your first price round, which is really the main difference. So, I mean, a Series A is a price round that typically involves more than $5 million, but sometimes you have seed rounds that are around anywhere between $3 and $10 million. Sometimes, at least until $5 million, you can call it a seed round and then a Series A round. But the more important thing is that it's the first price round. And so that's when you're negotiating governance. That's when you're deciding to set up a board of directors and who's going to sit on the board and what kind of vetoes that board member is going to have. And so that's when the founder has to start worrying more about control, right? Sometimes even after the first round, even though the investor might still have 70, 80% of the company, that's in a good scenario. There are already vetoes in place that don't allow him to sell the company, raise the next next round or get indebtedness, hire sometimes, set compensation, hire and fire executives. So that's a big change for him. And I have founders all the time calling me and being like, what can't I do anymore? And so he has to sign up to pretty extensive documents that lay out pretty much everything, like even how the IPO is going to be of the company. There's like rules, registration rights that you agree right from the first price round. So there's a lot of change there in terms of what the founder officially can and can't do. And I say officially because a lot of times the investors are going to be like very nice about it. Like these provisions are there for when we get into a fight. So sometimes the founder sees it as business as usual, but from the lawyer's perspective, things are changing a lot because we have to pay attention to what's written in the document, right? What's the actual rule there? So I always look at it from the perspective of the worst's going to happen. That's kind of my job, is to think about if the worst happens, they get into a fight, what makes sense here for the founder to accept. And the same thing for investors. I help a lot for investors navigate through these issues in Brazil, and they have to understand like what kind of protections they have to build in these documents in the first round so that make sure that the founder is going to be responsible and is going to loop them into the important conversations. And that's kind of the first moment, is the first price round, is when all of that gets to be decided. And sometimes it's annoying because you're talking about the rules of who has to vote when the company is sold. And sometimes that's going to happen like 10 years down the line. And so you get kind of stressful situations between founders and investors talking about a scenario where, first of all, is 10 years down the line. Second of all, hopefully people are going to be smiling, when they do that. But you kind of have to go through that process. And founders find it a little bit traumatizing because they have to keep doing what they're doing, but also pay attention now to due diligence. Because then in the first round, it's like full on due diligence. Get me all of the good standing certificates of this company. Questions about the last 5 years. How did you do your taxes? And how are you paying your employees? And
Yeah, all the stuff you didn't organize when you did your unpriced rounds.
and the founder inevitably starts feeling like, what did I do wrong? Right? He feels like he's in an investigation. And it's like, why didn't you think of this? Why didn't you think of that? He could just say, yeah, I didn't think of it because the company's early stage and we are focused on building a great business and that's it. More, responsible founders that worry a lot, they feel like, oh my God, how didn't I think of this? What did I do wrong? And it's like, no, it's normal. The founder is the business doing great. I got the check. And then all of a sudden you have to go through all these decisions of what can I accept? And founders sometimes complain about fees. And at the end of this process, they're like, oh, thank God. Like I didn't realize how much work it was.
Yeah. How many aspects of this are influenced by whether it's a foreign investor or not? And what's unique to Brazil about some of these stages? So we talked a little bit before about understanding the bureaucracy and the labor relationships. So maybe there's a firm coming in the Series A and like, why are all your employees contractors? You need to make them full-time employees, right? So that's an obvious one. Another thing that you hear about a bit, maybe more rumorish than actuality, Brazilian founders ask for secondaries a little bit earlier than foreign founders might. I think in a large part, Brazil is expensive. You take a really low salary and you want to take a little bit of money off the table. Where are there aspects of the uniqueness of the Brazilian startup ecosystem as you're getting into Series A, Series B, and later stage?
Yeah, so one distinction that we should make is between foreign investors that actively invest in Brazil and foreign investors that have never invested in Brazil or have rarely invested in Brazil. It's very different because foreign investors that are active, they see a pattern. Always is the case that when we invest in the startup, if you have some independent contractors not hired as employees, the company has not fully registered its IP and things like that. So they're unfazed by these issues because they see it all the time.
Right. Let's pretend that Isaac here is a new investor to Brazil. What are the things you're going to tell Isaac to not worry about and to watch for? And Eduardo, the founder, to be aware that he's going to get asked those things.
Yeah. So investors that are not used to, they see things like, for example, the company's setting up a new structure, an offshore structure, so they can invest. Sometimes it takes a couple of months to get that done. And it's hard for them to understand why some things take longer here, right? With all the bureaucracy. And then if they start asking questions about their liability as shareholders of this business, there are some key differences in Brazil. So for instance, the shareholder is ultimately liable for the company's labor debts if the company doesn't pay for these labor debts or tries to shut down without having these paid for. So, Brazilian or active VC investors, they have this put option that they sometimes ask for, which is, I want to be able to exit this business for $1 at any point in time because I see what can happen if the companies goes bust. And new investors sometimes are worried about that. Well, I thought that the amount that I invested, like that's all that I might lose. And if they realize that you can lose more, then they get scared. But things have developed. And so this concept that the VC fund is going to be sued and that somebody's going to go to the US and file a lawsuit, I mean, that typically doesn't happen. So I try to get foreign investors comfortable that, look, yes, there are some rules that are different here. And in terms of liability, it's a little scarier than, for example, in the US. But if you have your foreign structure in the US, then practically speaking, you're kind of shielded from that. So getting them comfortable that, this is something investors live with and there, very remote chances that something is going to spill over to you in the future. So getting them comfortable with the local legal framework is important, right? And in terms of diligence, like I said, if the IP isn't registered or if the privacy policy is not prepared yet, like that's normal and that, we can fix all of that at the time of the investment or right after. So yeah, sometimes they're not familiar with these things, but they typically want to invest with a VC that is active locally. That helps a lot. One thing is as a lawyer explaining to them, the other thing is, okay, half the check is going to be written by this very active VC in the region. And so I'm comfortable that he's looked at all of that, right?
What are the other considerations as you're moving later stage? Is there other stuff that you'd highlight, other things that you as a lawyer and advisor take up and things that you begin to drop? So heading into Series C, Series D, and then kind of thinking about the exit. So what are the pieces that you help with and that founders and investors should be aware of in the Brazilian context?
So as the company raises new rounds, they have to watch out more and more for dilution and control. These two elements are very important, right? The founder is going to get inevitably, if the business goes well, he gets to a point where he doesn't have the majority of the shares of the company, and he may not even have a majority of the board of the company, which is odd because he's the one actually running the business still. So sometimes he's going to go to a board meeting with 10 investors and he's going to know much more about the business than these other 9, board members. But ultimately, they have the power to override any decision from the founder. And so it's kind of a tricky situation where you're the one in charge. Everything's on you. You're the one that has to take the company public or become a unicorn. But at the same time, we hold the keys. If we want to shut it off, we can, right? And of course, at every round, another brick is laid. So keeping the governance clean and scalable is a big challenge because every time a new investor comes in, he's going to want something different, whether it be like a minimum multiple that he wants before an exit or different vetoes from the previous investor. And before you notice, you have like this collection of vetoes and one investor can veto this, the other can veto that. And so it's very important to guide founders to what makes sense here. Have a sanity check at all times at every round. And this is a challenge because a year ago, you already agreed to a set of rules. And now it's a different set. And the first investor is going to say, okay, but we agreed to this. I don't care. And then the new investor says, I don't care what you agreed before. I want this. So then you have to kind of balance all that. How much this investor owns, how much that investor owns. It makes sense that that investor has like 2% of the company can prevent a sale of the company. Does that make sense? You have kind of a living organism, if you will, and you have to really pay attention to all of that, whether it be excessive dilution or unbalanced control mechanisms, right?
Yeah, maybe a little bit more as we wind down here, thinking about the exit and thinking about the Brazilian ecosystem for later stage companies. And so there haven't been that many IPOs. It seems like more of the exits are M&A or companies staying private longer. What do you see in the kind of later stage and liquidity aspects of the VC ecosystem in Brazil? Kind of where is it now and where do you see it going?
Yeah, that's a good question. I mean, it is a challenge because most investors have a 10-year cycle. So they expect the company to get funded and for an exit to happen and return the investment to their LPs within that 10-year cycle, right? And what we've seen is that sometimes it takes longer. Sometimes it can take 15 years or more. And so that becomes a challenge. And of course, they have to be fundraising all the time, but LPs want to see results and exits before they reinvest. So right now is a tricky moment because for the past 3 years, we've had zero IPOs in Brazil, right? So M&A has become, in recent years, the exit path here. But we have challenges. We have the liquidation preference, which combined with the currency devaluation becomes a big problem for exits. So if a company received $200 million in investment, these $200 million, if they received them a long time ago, now used to be 600 million reais. Now it's 1.2 billion reais because the real went from like 3 to 6. The business is doing good. You could sell it for 1 billion reais, which is a lot of money. But in that scenario, no money would go to the founders. So a lot of these companies are sitting around and waiting for the markets to heat up again. Because if you're a big company and you're doing the kind of check that would be necessary for this startup to exit and everybody to be happy, which is, I guess at least 5 billion reais, then you need to get financed. And how can you get financed if the capital markets is where it is? So on the one hand, the ecosystem is pretty robust and it's maybe the best time to invest because valuations are more reasonable. And I think there's a lot of opportunity there, but there are challenges with liquidity. And I think founders learned the lesson the hard way. So before, it used to be the case that you would fundraise and you would spend all the money and then like maybe a month before the money runs out, you would go and raise your second round. Whereas a lot of companies went bankrupt or were sold because of that. So I think founders learned that the whole process takes longer and also timing is very important. So if you are going to fundraise in the worst possible moment, either you're going to get very diluted or you're not going to make it. So you have to be mindful of that for sure.
Excellent. And just, what are some of the reasons that deals fall apart?
Well, I think, as I mentioned earlier, trust is a very important element, very important, because in the beginning, you're trusting that that founder is going to take the company all the way and you don't really know what's going to happen as far as the business. And sometimes that trust gets broken. For example, sometimes if the founder starts working on a separate venture, he's tired and that's a breach of trust because the investor assumed that he was going to be full-time dedicated to that business. Also, I think this is something that is cultural, but Brazilians don't like to say no, and they don't like to bring bad news. So if sometimes the company had a past experience, for example, a co-founder that left disgruntled, and that could be a huge cap table problem. If you had a co-founder that owned, 30% of the business and then left and didn't sign anything, that's huge. But the founder just attracted the fundraise and everybody's happy. He doesn't want to tell this horrible story. And sometimes we'll find out in due diligence, hey, who was that person that used to own 30% of the business? And then like a week before the deal closes, we have to bring this story. And then sometimes we can work it out and fix it. And there's indemnification or whatnot. But sometimes the investor feels like, hey, you didn't tell me about this. How can I trust you? So that's when sometimes deals fall apart. And this is something that is totally in control of the founder, right? What he's going to tell the investor or not. Sometimes it's not in control. Sometimes it's something happening outside, like the pandemic or what happened in the US market that affected the local market. And so a lot of deals fell apart in 2022. And the myth that once you signed a term sheet, the deal is done was kind of like broken. We had deals that had signed term sheets that didn't go through because everyone was afraid of what was going to happen. Or if like the lead investor, the company raised money from a bunch of investors, but the lead investor pulls out and then everybody starts pulling out. So yeah, deals fall apart usually when something out of the ordinary happens, whether it's market conditions or an issue of trust between investor and founders, but it does happen with some regularity.
Understood. I always like to end these conversations asking two questions in particular, but what does the expression Brazil is not for beginners mean to you?
So that expression First of all, it is a little misleading because it gives the impression that Brazil is the most difficult place to do business. Whereas I can't think that Venezuela is for beginners or that Russia is for beginners, right? But maybe Brazil is so inviting. There's so many similarities in terms of culture. Brazil is like one of the most social countries. So it's very inviting, and it can be misleading in that, okay, it must be very easy to do business, but that's not necessarily the case. So Brazil is not for beginners kind of means that, look, things are not always as they seem. The rules may not apply here, and it can be something practical like a lot of bureaucracy, taxes, which I'm sure people have talked a lot in your podcast, or it can be something cultural like what I said. Brazilians don't want to say no. So sometimes they don't want to do something, but they'll say, yeah, why not? Or maybe, and then you end up finding out that they don't want to do it. Whereas I guess in the US or in Europe, like it's more like, do you want to do this or not? And if they say yes, that means yes. If they say no, it means no, right? And here, sometimes yes doesn't mean yes. So I think that's where it can get tricky, and you just need to learn how to interact with people, understand how things work here before you really dive into it, put all your chips in one bag. So
I really liked your answer. You came out with something I hadn't heard yet in saying that part of it is maybe because Brazil is so inviting. And so it misleads you into thinking it's going to be easy generally. So thanks for that insight. I think that's really valuable. And then you gave the example of Brazilians don't like to say no, but are there any other habits or expressions or things that you really enjoy about Brazil or that foreigners don't get?
look, there's one expression that kind of gets into the psyche of Brazilians, which is Deus é brasileiro. I don't know if you've heard that one.
So God is Brazilian.
Yeah, God is Brazilian. What that means is that no matter how tough things get, we're going to be saved at some point. God is Brazilian, so he's going to be on our side, whether it be a soccer match or anything, right? It will all work out. And that's very typical thinking because Brazilians are all the time complaining about politics and elections and how hard it is to do business. But deep down, they believe it's going to work out. And so that kind of tells you a lot about how Brazilians think, it's going to work out. God is Brazilian, right? So he wouldn't abandon us.
Love it. Yeah, great expression. Eduardo, thank you so much. This was great. I think we covered a lot here. Super valuable. How can people reach you if they're interested in learning more or learning about BZCP?
Sure. I'm very accessible on LinkedIn, and my website is bzcp.com.br. So there's my email there, and very easy to reach me.
Awesome. Eduardo, thanks so much. Really appreciate it. Thanks everyone for listening. Thanks again for joining us. This podcast was hosted by me, Isaac Matzner. It was produced and edited by Maria Filmis. You can find more episodes on Spotify, Apple Podcast, and YouTube, as well as on our Substack page. We do love feedback, so please feel free to reach out to us on social media or via email at Brazil, the number 4, beginners@gmail.com.